As of 10:36 a.m. Eastern Time, Beyond Meat, ticker BYND, is trading at $1.14 per share. That is a blistering, violent move up of 12.87% or 13 cents on the session. The trading volume is an absolute explosion, with over 51 million shares already changing hands. To put that in perspective, this stock's average volume is a fraction of that. The stock has ripped from a low of 93 cents to a high of $1.23, all in the first hour of trading. What we are witnessing here is a classic, brutal case of expectation versus reality. The expectation, for anyone who has followed this name, is that this company is in a death spiral. It's a penny stock, a broken IPO, a failed food experiment that is bleeding cash and on its way to zero. The reality, however, is what you see on your screen, a double-digit percentage pop that has absolutely nothing to do with fundamentals. This is not investing, it is a technical war. This is one of the most heavily shorted stocks on the entire market, and today the shorts are being taught a very painful lesson. The common belief, the one held by Wall Street analysts and reflected in almost every piece of research you can find on a Fidelity or Interactive Brokers terminal, is that this stock is an underperform or an outright sell. And why wouldn't they? The company just reported its third quarter earnings 4 days ago, and it was a horror show, a catastrophe. It wasn't just a miss, it was a fundamental breakdown of the business. Net revenues declined 13.3% year over year to $70.2 million. The company's net loss wasn't just a loss, it was a $110.7 million black hole. That's a loss of $1.44 per share. This compares to a loss of $26.6 million or 41 cents per share in the same quarter last year. The losses aren't shrinking, they are accelerating. They are burning cash at a terrifying rate, nearly $42 million in the quarter. Worse, the company took a massive $77.4 million non-cash impairment charge. In plain English, that is the company admitting that its factories and its equipment, the very assets it built to fuel a food revolution, are not worth what they paid for them. It's a write-down, an admission of a massive strategic error. Following that report, the analyst community did exactly what you'd expect. Mizuho slashed its price target to $1. Barclays cut its target to $1. TD Cowen reiterated its sell rating. The expectation was that this news, this confirmation of a failing business, would send the stock to a new 52-week low, which, by the way, is a horrifying 50 cents. The stock was supposed to breach $1 and head for delisting. And yet here we are, watching it trade at $1.14, up 13%. This is the disconnect. This is the reality that smashes the expectation. This is not a fundamental rally. This is not a new wealthy investor coming in. This is a short squeeze. A massive percentage of this company's float, its tradable shares, are sold short by hedge funds and traders betting on its demise. When a stock is this heavily shorted, any buying pressure, any small rumor can create a feedback loop. A few shorts get scared and buy to cover their position. This buying pushes the price up, which forces more shorts to cover, which pushes the price up even further. This is the coiled spring of financial market warfare, and it has just been sprung. This is a day for the traders on the Robinhood app and SoFi Invest platform, not for the long-term, self-investing portfolio. The sheer volume is the giveaway. When a stock trades 50 million shares in an hour on no news after a week of terrible news, it is a purely technical event. This is not NVIDIA stock reacting to a new AI chip. This is not Apple stock reacting to iPhone sales. This is a financial derivative of a company, a bet on a ticker symbol completely detached from the people making plant-based burgers in El Segundo, California. The reason this is happening is because the bears got too greedy. Data from Fintel and other market sources has shown this stock has an astronomical short interest, at times over 30% of the float. There are also tens of millions of fails to deliver on the books, a complex market plumbing issue that suggests extreme stress in the borrow and lend market for this stock. Today's 13% spike is what happens when that stress breaks. This is a game of musical chairs, and the shorts are scrambling for a seat. This is not a name you put in your Schwab Intelligent Portfolios account. This is a name you watch from a safe distance, unless you're an active, high-risk trader. Now, let's step back from the technical chaos of the squeeze and look at the actual company, because there is a company here, and it is fighting for its life. What does Beyond Meat even do? The expectation, years ago, was that it would change how we eat. It was the next great investment, a high-growth, ESG-friendly Tesla stock for the food industry. They make plant-based meat substitutes, burgers, sausages, beef crumbles, from pea protein and other plant ingredients. They had first-mover advantage, a blockbuster IPO, and partnerships with every major chain, from McDonald's to KFC. The reality? The product was too expensive. The taste and texture were not a perfect substitute for many consumers, and most importantly, a narrative took hold that the products were hyper-processed and unhealthy. That narrative, combined with post-pandemic inflation that sent consumers back to cheaper, private label, and traditional meat, was a kill shot to the company's growth. The competition just ate their lunch. The company's financials tell this story perfectly. The most recent balance sheet shows a company in distress. While they recently completed a complex debt exchange to push their 2027 convertible notes out to 2030, this was a move to buy time, not a signal of strength. They are still carrying a massive $1.31 billion debt load. Their free cash flow in the last 12 months was a negative $142.9 million. This is the cash burn everyone talks about. They are burning more than $40 million in a single quarter just to keep the lights on. A recent article from The Motley Fool had the headline, "Dilution is the only solution." This means the only way for them to raise the cash they need to survive is to print and sell new shares, which would dilute every existing shareholder and send the stock price even lower. This is the fundamental anchor that is tied to the stock, and it's the reason why the shorts are so confident. They are not betting against the burger. They are betting against the balance sheet. They are betting the company goes bankrupt before it ever turns a profit. So, what is the bull case? Is there one? If you ignore today's short squeeze, is there any reason for a long-term investor, perhaps someone using Fidelity Investments for their Fidelity IRA, to even look at this stock? The bull case rests entirely on one single desperate hope: the Beyond IV platform. This is their new fourth-generation product line, specifically the new Beyond Burger and Beyond Beef. The company claims it has addressed all the criticisms. The new burger has 21 grams of protein, but the saturated fat has been slashed, now using avocado oil. It's the first plant-based meat to be certified by the Clean Label Project. They are rolling it out now with partners like Hard Rock Cafe and the high-end grocery store Erewhon. This is it. This is the company's Hail Mary. The bull case is that this product is so good, so healthy, and so clean that it will reverse the entire negative narrative. They are also pulling back from costly failing ventures like their operations in China and focusing on markets where they are stronger, like Europe. The future outlook for this company is a perfect binary. There is no muddle-through scenario. There is no scenario where this company just putters along. The bull case is that the Beyond IV launch is a massive, unqualified success. It reverses the sales decline, it allows them to raise prices, and it repairs their gross margins. The short sellers, who are currently trapped in today's squeeze, are forced to capitulate and cover their position for good, sending the stock back to the $5 or $10 level. The company uses that momentum to raise capital on better terms and lives to fight another day. It becomes one of the greatest online investing turnaround stories of the decade, a true investment for those who bought at the bottom. The bear case, however, is far more probable. The bear case is that the BYND IV product, no matter how good it is launching into a market that has already made up its mind. The brand is damaged. Consumers have moved on. The $77 million impairment charge was the company admitting its old strategy failed, and this new one is too little, too late. The cash burn continues. The $42 million per quarter deficit cannot be stopped. The debt load is too heavy. The stock, despite today's squeeze, will eventually be crushed by the weight of its own financials. The company will be forced into a painful dilution, a reverse stock split just to stay on the NASDAQ, or ultimately a Chapter 11 bankruptcy. In this scenario, everyone on the Robinhood stock trading app who bought into today's squeeze gets wiped out.